Welcome to the Joe DeLisi Financial Advisor Podcast. I'm Joe DeLisi. We're going to talk about fees today. I get this question, not as much as I used to, but it's still out there floating around. I actually had a client, a good client of mine, email me about a week ago. And it wasn't directly about fees, but it was kind of in a roundabout way it was. It was really, it was a video that was talking about the fact you really don't need advice. You just need the S&P 500. And I'm not sure where it came from. I think it was Instagram. My own daughter, my 17-year-old daughter, who invests money herself. I mean, not by herself, but she also invests money. She was asking me the other day. She's like, hey, is the S&P 500 a good investment? And why don't I just put all my money in there? Because it's pretty cheap. You know, and on its face, it's logical, right? It makes sense. But if you step back and think about it, cheap rarely wins the day, at least over time. You know, if you think about how we operate in our real lives, we don't want the cheapest airplane ticket. You know, I mean, certainly if we could get from A to B in an airplane and all the seats were the same and the tickets were the same no matter when you flew, well then sure, you know, you're going to look at price, you're going to look at cheap. But value comes into it, right? So if you're on an airplane or going to take an airplane somewhere and you want to get there quicker, you know, you don't want to stop and change planes, and you don't want to have a layover, and maybe, you know, you don't want to be the last person on sitting all the way in the back, or whatever the case might be. Well, now it's not a commodity anymore. Now you're looking for value, and cheap, again, rarely will win that day. I'll give you another example. We have, there's about 5 acres of land that we were watering, okay? And that bill was about $1,000, on average, about $1,000 a month. That's what it cost us to water the land. You know, a little bit less in the winter, more in the summer and spring. So you're talking 12 grand a year. Now, we decided to sink a well or tap, you know, put a well in there and tap the water that's underground, and it was deep. And it was a $34,000 cost. It's a lot of money. But it wasn't a cost, like I just said. It was a price. Because when we looked at it, we said, okay, if we pay the price tag of $34,000, not cheap, right? That's not a low price tag, at least not to me. What's the trade-off? What's the value we're getting for that? And what it turned out to be is our water bill, instead of averaging $1,000 a month, it's now averaging about $80 a month. Now, that's an insane value. The price tag was still $34,000 to sink that well, but is there truly a cost to it? Well, no. I mean, after 2.5, 3 years, we're positive in that deal for as long as we live here. We're making money on that deal. High price tag, no cost, because a price tag is an accounting function, right? I give you this, you give me that. Cost is the overall long-term effect on your wealth. And so whether it's purchasing a car or an airline ticket or the kind of coffee that you like or putting a well in your yard, you can't just look at price tag. But I know that we all tend to, as humans, we do. We just assume everything's a commodity. And, you know, really that's what the premise of a lot of this advice that's out there on places like TikTok and Instagram and X. It's showing you investing as if it's just a commodity and that there is no value in different types of portfolios. And I'm going to prove that wrong today, I think. And I want to there's some other housekeeping we have to do here. You know, the advice industry is different. So if I was not licensed the way that I am, I could go out there and there'd be no regulation on me. I could say pretty much whatever I wanted. I could give you advice on TikTok or Instagram or Snapchat or X or whatever platform it was, YouTube. I could pretty much say whatever I wanted. I could compare anything to anything. There's no regulation. And if you took my advice and it wound up being bad advice and you got hurt from it, there's really no recourse for you because I'm not licensed if that was the case, right? If I was unlicensed. And that's what you're seeing out there in the social media landscape. But I am regulated and I am licensed. And so if you're listening to this and you're my client, you know, I have oversight. I can't just say anything that I want. It has to be true. It has to have a foundation in truth. It's got to have data behind it. And if you are using an advisor who's not me, I would bet that they're probably licensed. And so they can't just say anything. So there's a very big difference in listening to, whoever you're listening to on social media or on the radio, or even in a book you might read. Those platforms seem like, well, gosh, this guy wrote a book. This woman's on Instagram. They've got a big following. Obviously, they're saying is accurate. Well, we don't know that. Again, there's no regulation, right? So maybe what they're saying is accurate, but maybe it's just what they decided to say that day, and they recorded it in 2 seconds and threw it out there. So be careful as to what you're listening to. Now, let's talk about cheap in the investing landscape. It's kind of this idea of you probably have heard the phrase S&P 500 and chill. Okay. Now, why are people saying that? It's twofold. One, investing in the S&P 500, you can't invest in the index directly, but you can buy an index fund or a mutual fund or something that mirrors that index. And those funds tend to be very low price. There's not a lot, it doesn't cost you a lot of money to buy one of those bigger, well-known funds that anybody can go access on their own. They don't even need an advisor. And they're very, very low price tag. And you compare that to a portfolio that we might build for a client, where we're going to say, well, look, it's going to take more than just the S&P 500 and chill. You have other markets, other indices, other areas that your money should be diversified in, things like small cap US stocks and small cap value US stocks and international and emerging markets. There's a litany of things out there that we use to build portfolios. And then obviously we also offset some of the risk that is inherent in any kind of stock market investment by using things like high quality short-term bonds that will help reduce the volatility. So we're talking about comparing, portfolios to, let's say, one asset class. And so today we're going to do that. We're going to spend some time and do that. Now, a lot of the advice that I hear, it'll start. What's interesting is it typically starts in like 2000. That's what is referenced a lot. They go back and they run it, for 25 years, and they say that, this is what you should do. And sometimes it's only the last 10 years and whatnot. I'm going to use 25 years to start. It's a quarter of a century. It's a long period of time. And we're just going to look at different rates of return. And I'll let you choose for yourself, where the value might lie. And so if you're looking at the screen, if you're not, by the way, if you're in your car, you're not on Spotify, you're not seeing the screen, I'll sort of go through the data for you verbally as best I can. So right now on the screen, if you are looking, I'm just going to put $100,000. I'm going to start in year 2000, and I asked for a 25-year study period. Now, let's actually do a little bit more house cleaning here. This is the data we're going to use. And so for the US large stocks, I'm actually using the S&P 500. Okay, that's what we're using. When I reference small stocks, we're going to use the Ibbotson Small Company Stock Index. That's good through 2021. And then from 2022 till present, we use the MSCI US Small Cap 1750. For large value, when we talk about that, anything with value, large value, small value, international value, we're using the Fama French Index from the University of Chicago. So these are not funds you can go buy. These are indices, okay? And this is publicly available. This is information you can get on your own. If we put $100,000 in the S&P 500 in 2000 and we just let it run, we chilled, and we never worried about anything. We never worried about the fact that it drops and all that kind of stuff. It would have grown to $651,000 in change. All right. And so let's pull up an efficiency calculator or a rate of return calculator. And what you'll see on the screen here is $100,000 growing to 651. And I'm just rounding it down a little bit. Over 25 years, that's about a 7.8% rate of return. All right. So for 25 years, you put it into the S&P 500. And let's just say you were able to invest in there for free. Okay. So you can get that fund or ETF at very, very low price tag. I'm just going to make it easy and say you can get it for free. And there's no fee associated with it. Your rate of return through the end of last year, through the end of 2024, comes out to be about 7.8%. Okay. Now, let's talk about the S&P 500 for a little bit. And we've talked about this probably ad nauseum on this podcast, but it's I think worth going through again. So this data is coming directly from Yahoo Finance. You can go and you can type this in and find it for yourself. The S&P 500, that means there's 500 stocks in that index, okay? Currently, the top 10 stocks, so we've got 10 stocks and then 490 stocks behind that. The top 10 stocks according to Yahoo Finance, currently comprise 38%. Like 38% of the money would be concentrated in those top 10 stocks. All right. So that's a very high concentration. And according to the Yahoo Finance, is actually the highest concentration we've seen currently since at least 1980. I went a little further and said, okay, great. What about the top 50? This blew my mind. I wasn't expecting this. The top 50 stocks of the S&P 500, you've got 60% concentration of money in those top 50. So way more than half of the concentration of your money, if you invest in that index, would be in 50 stocks, not 500. So that's challenging, right? Because you've got a very heavy concentration in things, mostly in tech, especially in those top 10. If you go and you pull it and you look at it, you're going to see, the usual suspects of tech. You're going to see NVIDIA, you're going to see Tesla, Apple, Microsoft, et cetera. And I'm not suggesting those companies are good or bad or right or wrong. I'm just saying you're very heavily concentrated there. Now, let's also talk about this. If we go back and you use Yahoo Finance to do this, and what I wanted to know was, all right, for the last 25 years, we've gotten almost an 8% rate of return, 7.7, 7.8%. But listen to some of these time frames where you had very little return in the S&P 500. Okay, so from 1966 through 1974, you were about flat. Again, we're not using fees, and this is nominal. So I'm not taking inflation out of this. Okay, so I'm not like saying, okay, for instance, from 66 to 74, the rate of return in the S&P 500 was less than 1% nominal. Now, if I applied inflation to that, it would be negative, but I'm not doing that. So we're just going to set inflation aside. We're going to set fees aside. We're going to set taxes aside. That's one very long time frame. From 1999 through 2009, you had a roughly negative 1% nominal return in the S&P 500. Going back again from 1966 all the way through 1981, what is that, 15 years or so, you had a roughly 2% rate of return, nominal, again, not including fees or inflation. So 15 some odd years, and you only had a 2% rate of return. And more recent, if we take a look at 1998 through 2013, the S&P 500 would have given you about a 4% rate of return. Why am I bringing that up? When somebody says S&P 500 and chill, there's no context around it. They're not explaining to you that, listen, in order to do that, in order to get the 7.8% rate of return, you are likely going to have to go through some very, very difficult times, some scary times, like 2008 times, right? Where you're down 38%, something like that. You have to almost act like a robot. You have to go through potentially a decade of very little or no return, or 15 years of very little return. Like, you have to sit through that. That's the price tag of getting the long-term rate of return, is you have to go through these very difficult time periods. Now, it's easy right now. I would suggest to you, we're basically in the golden age of the S&P 500. If you go back and look at my screen, I'm going to scroll down here. Okay, so we're looking at, I'm going to actually change this. I'm going to go back all the way to 1973. I want you to see why I'm doing this. It's a 52-year study period. We're going to hit restart. I'm just going to click on large stocks. Okay, now really what I'm doing here is I want you to see down here, it says best. If you're in the car, what best means is that for the last 52 years, the S&P 500 was the best asset category, at least according to some of these other indices that we can look at on the screen here, 7 times. So it was the best asset category 7 times out of 52 times. That doesn't mean one thing or the other, but what's interesting to me is if I count the green, which would show the best in any given year, it was the best in 2024, 2023, 2020, 2019, and 2015. In other words, 5 of the 7 best years for the S&P that it won, quote unquote, happened in the last 10 years. The S&P 500 has been incredibly popular recently. And that's where this advice is coming from, in my opinion. It's the Johnny-come-latelys. It's the chasing the hot return. It's the recency bias. It's the, hey, put all your money in there for essentially no price tag whatsoever and just sit on it and just act like a robot, go through the ups and downs, don't worry about it, everything should be fine. But really, this is, again, a time period where the S&P 500 is just the best asset category. Now, will that continue? Nobody knows. Nobody knows, but history would suggest that assets tend to move around. Risk premiums exist in other areas, not just US large cap companies. And I'm going to give you some data on that. Okay. So let's look at, let's go back and we're going to take you back to that starting in 2000 so we can keep our comparisons the same. So 25 years, restart, S&P 500. Why did it go all the way back? Let's reset it. How about that? If you're looking at the screen, 100,000. We're going to go back to 2000. We're going to go for 25 years, and we're going to click US large, and there it is, 651. That's that 7.8% rate of return, okay? Now, what if I, instead of investing in the S&P 500, same time period, I didn't buy the S&P 500 and chill, I bought US small stocks and chilled. Now, here we've got a situation where that didn't grow to 600 and whatever thousand, it grew to 972,000. So S&P 500 would have grown to 651, US small would have grown to 972,000. Well, what about US small value stocks? Again, just another market. Same period of time, it would have grown to $1.3 million. S&P 500, 651, US small value, 1.3 million. Why? Well, I would submit to you that there's more risk. Okay, so we talk about risk premiums. Premium is a payment. You, the investor, are going to get compensated or potentially paid for risk you're willing to take. And presumably, smaller companies have more risk relative to larger companies. Value companies have more risk associated with them than growth companies. And so we see that premium play out. Now, if you were to take your $100,000 and you were to invest it in the S&P 500 in 2000 and you ran it all the way through last year, as we said, you would have grown to $651,000 and forget the fee. No fees, no inflation, no taxes. What I want to look at is, well, what if we took that $100,000 and we divided it equally among those last three things we looked at? So we'll put a third in the S&P 500. We'll put a third in U.S. small company growth and a third in U.S. small company value. What I'm doing now is I'm simply taking, for instance, you got the 1.315 million on the screen here. If we take that and we divide that by 3, that would give us roughly $438,000, okay? So at the end of the 24 years, you'd have $217,000 in the S&P 500 fund or index. You'd have the small cap value is 438 and small cap growth would give you 324. You would have grown your 100,000 in that trifecta portfolio evenly divided. Again, no rebalancing, just buying those three and chilling. You would have grown to $979,000. Put your money in the S&P 500, it would have grown to 651 for a 7.78% rate of return. Put your money in that trifecta portfolio, and it would have grown to $979,000 or a 9.55% rate of return. That's a delta, that's a difference of 1.77% per year. Now, if we say, let's just say the S&P 500, you can go invest in that for no price tag whatsoever, okay? It's just free. But it's not free to invest in small cap growth and small cap value. My question to you is, do you really think that it costs you 2% a year in fees inside those asset categories to invest? And I would submit to you, absolutely not. I know in our portfolios, I can tell you in our portfolios that we use small cap growth and we use small cap value among other asset categories. It's not even close to a 2% year. Is it more expensive than the S&P 500? Of course it is. The price tag is higher. It's more expensive to invest in small cap companies. It's more expensive to invest in small cap value. It's more expensive to invest in micro cap. It's more expensive to invest internationally in international small and value in emerging markets. It's more expensive to do it. The price tag is higher, but the cost is what I'm looking for. All right. So just going back to what we said here, we invest in the S&P 500 for free and you grow to 7.78%. You invest in that little trifecta portfolio and you grow to 9.55%. If the fee, and I'm just going to pull this out of the sky, okay? If the fee is 0.5%, let's say, and I would submit that's probably high, but let's just say it's 50 basis points to invest in those other asset categories, but you picked up 1.77 a year. You paid a higher price tag to invest, but your cost was nothing. You gained a significant amount of money, just like my example at the start of the podcast on the well. Yeah, the price tag was ridiculously higher than not putting a well in. I could have just not put a well in and kept 34 grand in my pocket. Or I could write the check for $34,000 and drop my monthly cost from $1,000 to $80. And over time, I make that up in spades. And that's really the lesson on investing. It's not price tag, it's cost. It's the overall long-term effect on your wealth. And I'm going to take it one step further before we end this podcast. Okay? Because again, this won't be the last time that my daughter or my clients or colleagues of mine, other advisors, are going to suggest to me or ask questions of me of like, why are we investing in these other asset categories? It's not just the last 25 years. It's significantly longer than that. I mean, we can slice and dice all day long and look at all different kind of time frames. The reality is we never know where the risk premiums are going to present next. I don't know. For this year, as an example, if you go look at Yahoo Finance, international small cap value is up roughly 26% year to date, while the S&P 500 is up about 7%. Who could have predicted that last December? Heck, who could have predicted that when the Trump administration started rolling out the tariff conversations earlier this year, and people were saying, oh, international stocks are going to get crushed. Inflation's going to skyrocket. I mean, there were all these predictions out there. And predictions are hardly ever true. Like sometimes they are, but nobody knows when they make the prediction if it's actually going to happen or not, because nobody can predict the future. And so we don't know which risk category is going to be the winner next year. We just know what's done well recently, and we also know what's done well over time. And so let me give you some longer data. Let's go back to 1973. Okay, so we're going to go back to that 1973 time period in 52 years, and we're going to hit restart. And if we put $100,000 in the S&P 500, it would have grown to $21 million, which is it's just an insane number. Now, what's funny about this is if I stop this in 2018, so if we just go 48 years, well, actually, let's just leave it there. If you look at the screen, 48 years takes me through 2020. And a minute ago, we talked about over 20 million. Going from 1973 for 48 years instead of 52, we almost lose half the return not of the overall asset category. So it's $12 million, not over $20 million. It's just how compounding works, right? So going back to 52 years and hitting restart, your $100,000 in the S&P 500 would grow to $21 million and change. A phenomenal rate of return, right? A phenomenal compounding effect. Over the same time, if we had bought the U.S. small growth instead of U.S. large growth, it's almost double. Actually, it's more than double. It's $50 million, not 21 million, 50 million. If we bought U.S. small value, it's over $130 million. So this is half a century of data. If we look at U.S. large value, that index, it's 43 million. Again, remember the S&P 500 was 21, U.S. large value is 43. International value was 38 million, again, soundly beating the S&P 500. International large was the only lag with roughly 7 million compared to U.S. large of 21 million. What's my point in walking through this? Well, the S&P 500 is the darling right now. It's the darling of the influencers, I guess, for lack of a better term. I'm not singling anyone out in particular. I'm just saying, generally speaking, it's what we hear all the time. Just throw it in there and forget about it. But if you did that, you could run into a 15-year time period where you had very little rate of return. Are you really going to do that? Or is it more prudent to diversify your assets, to put your money at work in multiple different assets? Not just in the US, but internationally. This year's a great example. International is really giving us phenomenal returns. Nobody could have predicted that. And so if you're my client and you're listening to this podcast, as we build your portfolio, we are not chasing anything. I'm not speculating on any market or stock. I'm not gambling with your money. That's not what you pay me to do. I am totally unemotional about your money. I don't expect you to be unemotional about your money. So I expect you to hear these things on things like Instagram, TikTok, et cetera, and question, wait, well, why are we doing it this way when all we have to do is do what this guy's saying? We can cut all these fees out of there. I get it. All right. That's kind of an emotional response. It starts off logically. It sounds logical, but when you really dig into the data, it's not logical. And so my job, being very unemotional about it, is to explain to you again, look, we're not going to place all bets on red. We're going to spread that risk across geography, capitalization, and stocks versus bonds. Not all of you are 100% equity. We have fixed income to reduce some of the volatility. And so to sum up, when you're looking at your portfolio and you're listening to this data, it could be your brother-in-law, it could be your best golfing buddy, it could be somebody on social media, it could be your 17-year-old daughter, like mine, or your 24-year-old son who has been investing for a few years, and they bring this to you. Understand that they're looking at a very short-term time period, and that's not what we're doing. We're building your portfolio on data and on science and on math. We're not just saying, well, this has been hot recently, and so I'm going to go chase that for you. We're not going to put all of your money in international because that's the winner this year. We're not going to flip back over to U.S. growth and tech when that sector starts to perform. We're not going to throw all your money into real estate as that starts to kick off. We're not going to chase these Johnny-come-lately ideas. We're building your portfolio on sound mathematical principles, because the purpose of your money is not to beat a market. It is not to beat your best golfing buddy. The purpose of your money is to simply fully fund your financial planning. And inside of your financial plan are all the hopes, dreams, and desires that you've got. It's buying the new house. It's buying the lake house. It's sending your child to college. It's giving money to charity. It's having a legacy for your children. It's retiring early. It's whatever it is that you can dream up that together we're working on and we're building a plan around. Your assets, your investments are there to fully fund those dreams and desires, not to beat the market, not to beat TikTok influencer advice, not to beat the radio talk show host, not to compare your portfolio to your next door neighbor. It's none of that. It's much greater than that. And so we take that very seriously. And so when we build your portfolio, it's again on math and science, not feelings and instincts. We'll talk to you soon. Now, let's deal with our favorite part, which is compliance. Registered representative, financial advisor, Park Avenue Securities, LLC, Pass, OSJ 5280, Carroll Canyon Road, Suite 200, San Diego, California, 92121, 619-684-6400. Securities products and advisory services offered through Pass, member FINRA, SIPC. Financial representative, Guardian Life Insurance Company of America, Guardian, New York, New York. Pass is a wholly owned subsidiary of Guardian. Westpac Wealth Partners, LLC is not an affiliate or subsidiary of Pass or Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC, California Insurance License OD34103. This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note the individual situations could vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guardian subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. Diversification does not guarantee profit or protect against market loss. Equities may decline in value due to both real and perceived general market, economic, and industry conditions. Investing in securities of smaller companies tends to be more volatile, less liquid than securities of larger companies. Investing in the bond market is subject to certain risks, including market, interest rate, issuer credit, and inflation risk. This material is intended for general use. By providing this content, Park Avenue Securities LLC and your financial representative are not undertaking to provide investment advice or make a recommendation for a specific individual or situation, or to otherwise act in a fiduciary capacity. Past performance is not a guarantee of future results. Indices are unmanaged and one cannot invest directly in an index. 814-9808.1 expires July 2027.